Now, our close contact, Goldman Sachs liquidity provider, figures this advisory to instigate fresh silver positions will be announced when silver tests $40, which clearly indicates they expect a gap close to $50, which will quickly follow. Obviously, along the way, we expect the cartel to also rinse out any fresh spec longs they can, but with the unallocated to physical lines actually now crossed, collectively, there's far more to be gained to see silver above $50. So dips from here on are going to be bought. And obviously, that is something that is going to offer opportunities. So bullion bank targets of $40 look compelling. However, tagging $40 will spill blood in the water.
Silver prices have climbed to $36 per ounce, buoyed by a weakening US dollar that has provided tailwinds for precious metals across the board. This upward movement comes as prominent market analysts and major financial institutions are issuing increasingly bullish forecasts for both silver and gold, suggesting the metals may be on the cusp of a significant breakout. Andrew Maguire, a well-known precious metals trader who has gained recognition for exposing manipulation in gold and silver markets, reports that Goldman Sachs anticipates fresh silver positions to emerge once the metal reaches $40 per ounce. According to Maguire's analysis, this level could serve as a crucial catalyst, potentially triggering momentum buying that would drive silver swiftly toward the $50 mark once $40 establishes itself as solid support. Market analysts are projecting silver could reach between $40 and $50 per ounce by the end of 2025, assuming current demand trends persist. However, in a more bullish scenario, where inflation accelerates and gold achieves new record highs, silver could potentially surge beyond the $50 threshold, marking territory not seen since the metal's historic 2011 peak. The convergence of major bank forecasts has added credibility to these projections. Maguire notes that Bank of America recently made headlines with their call for $4,000 gold and $40 silver. While ambitious gold targets have become more commonplace among analysts, the silver projection caught many market observers by surprise. Particularly noteworthy was the timing of this public advisory, which coincided with Goldman Sachs actively promoting their proprietary long silver position to clients. Supporting the precious metals bull case, J.P. Morgan Chase has also joined the chorus of major banks, forecasting dramatic price increases for gold. The investment bank expects gold to cross the $4,000 per ounce milestone next year, driven by increased recession probabilities stemming from heightened U.S. tariffs and the ongoing trade tensions between the United States and China. J.P. Morgan projects gold to average $3,675 by Q4 2025, with potential to surpass $4,000 by Q2 2026, possibly sooner if demand outpaces expectations amid shifting market or geopolitical conditions. Before we begin, make sure to subscribe, hit the bell icon, and share this video with others. Your support helps us spread these insights even further.
A slew of LBMA bullion banks are publicly breaking rank. Now, last week, the Bank of America openly called for $40 silver and $4,000 gold. And nothing new in that about gold. But silver surprised a lot of people. And funnily enough, their advisory, by no coincidence, jived with Goldman Sachs, aggressively talking up their long house account silver book, and that is house account. And as we've been reporting by way of our Goldman Sachs liquidity provider for some time, the in-house Goldman Sachs advisory for their clients to get long silver has actually been in place since April. I don't see any surprises here. However, last week's public advisory, that is, ahead of non-farm payrolls, which is most unusual to see a move before a non-farm payrolls, which of course they would have had the data of ahead of time. But it not only spilled the beans on quote, staying long silver, as they put it, but also advised holding fire on adding longs until the bid-only short squeeze played out in full. And then they said to action, quote, significant spot and futures long additions should be initiated. Now, our close contact, Goldman Sachs liquidity provider, figures this advisory to instigate fresh silver positions will be announced when silver tests $40, which clearly indicates they expect a gap close to $50, which will quickly follow. Obviously, along the way, we expect the cartel to also rinse out any fresh spec longs they can, but with the unallocated to physical lines actually now crossed, collectively, there's far more to be gained to see silver above $50. So dips from here on are going to be bought. And obviously, that is something that is going to offer opportunities. So bullion bank targets of $40 look compelling. However, tagging $40 will spill blood in the water, attracting momentum-fueled sharks who will undoubtedly want to test for stops by stops above all-time highs before seeking to ring any kind of register. And as we've evidenced at every spot round number being taken out, pullbacks to these round numbers have become bricks-centric supports. And once 40 becomes support, and once those stops are breached, it will become support. And the rally to close the $50 gap will commence. The bigger clues are all there. So while gold has been contained between 3,300 and 3,400, still is at the moment, silver has finally broken out of, and it's been tripping off very large official shorts related to the gold-silver ratio trade. And while currently contained at and below the 36 level, the odds of targeting the next layer of short stops at $38, which we talked about last episode, opens up a path to $40 sooner than the market is actually currently structured for. So really, in summary, while the unwind of the ratio trade is short-term weighing on gold, Asia is buying, and higher stair steps are being anchored in both. Following the bullion bank advisories, silver open interest, the silver futures open interest, which is easy to track, has ramped up significantly, as you can see here, with the CME physical silver cover also ramping up into a race to repatriate.
The relationship between gold and silver prices has become a focal point for precious metals analysts, with current market dynamics suggesting significant undervaluation in the silver market. Andrew Maguire, the prominent metals trader known for his market manipulation exposés, argues that the prevalence of gold-silver ratio trades has artificially distorted pricing mechanisms, creating what he believes is a substantial opportunity in silver. Currently, the gold-to-silver ratio stands at approximately 94.4 to 1, meaning it takes roughly 94.4 ounces of silver to purchase a single ounce of gold. This ratio has been fluctuating within a relatively tight range recently, hitting a high of 94.615 and touching a low of 90.342, but consistently remaining well above historical norms that many analysts consider more reflective of the metal's true relative value. According to Maguire's analysis, this elevated ratio represents a dramatic departure from what he considers the natural relationship between the two precious metals. He points to a historical ratio of approximately 10 to 1 as being more representative of the metal's fundamental supply and demand dynamics. Under this framework, if gold maintains its current price levels, silver would theoretically be valued at around $300 per ounce, a figure that would represent an explosive increase from current levels. Let's get back to the interview.
Now, while the headline data evidences the silver cartel is now building one of the largest ever short positions against a race by speculators to now chase a rising price, because silver now looks like it's going to even outperform gold at this point, and due to position concentration, there'll be an opportunity for these agent bank pit managers to orchestrate some wash and rinse cycles along the way. And we've seen a little bit of that here, but we think it's going to be, they're not going to go naked short. And so what's happened is, really, when we look at these bank positions, they're actually, because they're long their own books, what they're doing is they're hedging. These shorts are hedging physical positions. Now, obviously, they're not one-to-one, but they're not naked short, which means that dips will be shallow. To explain this, it would be a good idea to address the gold-silver ratio part of the question. Now, most of these official derivative bets against silver have migrated into the ratio trade, driving an otherwise implausible gold-to-silver disconnect where it's taken up to 120 ounces of silver to buy just 1 ounce of gold. And while this has now begun to unwind, it still requires over 90 ounces of silver to buy 1 ounce of gold. That is unsustainable. And the level of synthetic silver leverage is just not plausible. And while the natural ratio should be, say, 10 ounces of silver to buy 1 ounce of gold, valuing silver at current gold prices at $300 an ounce, liquidity providers figure an interim gap close to 35 to 1, which is pretty much what we saw at the end of the 2011 sell-off, which was the sell-off from $50. And even with gold currently at underpriced levels, it would put silver at $100 an ounce. And that is realistic. Now, the gold-silver ratio trade is now actively in the process of harvesting asymmetrically imbalanced short bets against silver. So bottom line, silver's short hedge against gold is being called in, which involves selling gold to buy silver. So you see a bit of weight on gold. But this inverse trade has massively expanded after the bullion banks came out of the gate last Thursday, literally to buy silver, and involved selling some gold. Now, short term, as silver is left to run higher to begin to close the imbalance, obviously it's weighing on gold a little. And the activity we're seeing now is the usual volatility around CPI. Even though it was a miss, you get the usual gaming around those levels. So there we are, gold and silver as we are today. However, with China actively alchemizing this synthetic imbalance, buying both physical gold and silver, both gold and silver are in the process of securing higher physically supported stair steps. Now, this is the core reason why the silver cartel is not naked short silver against a rising price. Now, notably, we're now evidencing silver being talked up, just as we experienced in gold when the bullion bank cartel moved to become fully Basel III compliant. Now, realizing the BRICS physical market dog was actually wagging the shrinking COMEX derivative tail, and they had built up very long in-house physical gold positions, if you remember. This is when the cartel of bullion banks began publicly talking up their long gold book. You remember, they were talking about 4,000, 3,500, 4,000, 4,500 even. However, once 3,500 gold is breached for a fix, we expect Chinese traders to front run a race to 4,000. Now, we saw it when the Shanghai Futures Exchange launched. We saw the relentless buying, momentum driven, but long enough at each stage to bring the physical level, the support levels higher. That's how stair steps are formed. And when we look at the COMEX data for gold, the distinct lack, you see it, of long Western market participation is incredibly bullish, as it limits the sell ignition triggers. In other words, bid pull, try and target some stops, long stops, create this sell ignition, everyone races to get out. It makes it very difficult. So therefore, the dips are shallow.
Gold faces short-term pressure while silver shows stronger momentum, supported by increasing physical demand and strategic positioning by major market participants. With silver advancing more aggressively and establishing higher support levels, both metals appear poised for continued gains. The current structure favors silver, leading the way, with gold expected to follow as broader market forces align behind both. Is this the beginning of a major move for both metals? Let us know your thoughts in the comments, and don't forget to like, share, and subscribe for more updates.